Welcome back, everyone, to another episode of Insightful Principles. Today, I have one of my great friends here on the show again, Alex Cole. And it's definitely been some time since the last time we talked with the Bitcoin conference that happened earlier this year in April. And a lot has changed since then, especially in the crypto space. And we wanted to take some time with this episode to kind of just educate you all on what were some of those major events that happened throughout the year so far within the crypto space, and really just giving our take from a global macro perspective of educating you on what we kind of expect for the rest of the year. But Alex, welcome to the show once again, man. I'm happy that you're here today.
It's always good to be back, Kevin. This is our third or fourth, I think, podcast together, and it's getting more exciting as we go because you and I are both just constantly communicating, and just our education levels are going up in the space, and I just feel the momentum building. So thanks for having me back. It's always a pleasure. I think last time we were riding that Bitcoin high, we had that conference down in Miami, and you and I did a quick update on the conference and just had so much energy and momentum at that time. A lot has changed since then.
It has.
We'll discuss.
Oh, it has. And, how has life been since the last time we talked? I know it's been some time. You've had some great, life events that has happened recently, but kind of catch me up on, how things been since the last time we talked.
Well, it's been good. It's been very busy. I think life's, we can say, back to complete normal, post-COVID. A lot of weddings this year, one being my own, so got married recently, so that's one of the big life events this year. Back in grad school as well, started that back up in the fall, so things are just moving forward, I can say.
That's good. Yeah, and congratulations. I told you offline, just congrats on, recently being married. It's just a beautiful thing, but yeah, man, I'm glad to hear, things have been well with you. And I kind of wanted to start, this conversation off on talking about, one of the major events that happened about in May of this year with the Terra Luna ecosystem. And pretty much what happened was that whole situation, along with Three Arrows Capital, created more of a ricochet throughout the whole crypto market. And just to kind of provide some context to you all listening and watching on what happened, Terra Luna Terra, I should say, is an open source protocol. The owners of this protocol is Do Kwon and Daniel Shin. And Terra, they also issued one of their cryptocurrency coins called Luna, which is a smart contract cryptocurrency similar to Ethereum. And Terra, they also issued their stablecoin, which is Terra USD. And this is an algorithmic stablecoin. Now, Terra USD, the way their protocol was designed was to maintain its peg to $1 using an arbitrage strategy. So what that means is for every $1 of Luna that you will have, it was always redeemable for $1 of Terra, and vice versa. So when UST, which is the stablecoin, when it fell below $1, arbitrage traders were incentivized to buy UST and to redeem UST for discounted Luna tokens. Now, when UST would go above $1, the incentive was to burn Luna for UST and then flip UST for any other stablecoin to make a profit. So what ended up happening was on May 7th, a coordinated attack managed to destabilize UST from its $1 peg, and 2 billion of UST was unstaked and immediately sold. So what happened in result of this is the UST price actually dropped all the way down to about 91 cents. And when many UST holders found out about this depegging, this is really when the liquidity withdrawal process started to happen, where a lot of customers started to respond by unstaking and selling their coins, which led to tremendous selling pressure. And this essentially was a bank run that Terra was not ready for at all. Now, the Luna Foundation Guard, they ended up having to sell about 2.2 billion in Bitcoin reserves to try to repeg UST and to stabilize Luna, but this was not a success as well. And the price of Luna completely fell off a cliff. It went from somewhere around $82 back in April, May, and now it's somewhere at close to 0 cents. So, and this event really contributed to a cascade of selling across the crypto sector, and many crypto projects relied on both UST as a stablecoin and Luna as well. So, Alex, before we kind of go into details on how this event impacted and created just more impact across the crypto space, what were some of your thoughts when you first heard about the Terra Luna situation, when you first started to see all of this unfold?
Yeah, Kevin. I had a lot of friends that unfortunately were invested in Terra, so they had not a ton, but there was some skin in the game with Terra. Quite a few close friends, and I remember that morning people just saying, "What's going on? Like, why is the price plummeting?" I mean, it was up there at one point. I think 120 is where kind of that peak was, and then it dropped down to the 80s. People were freaking out, and then it just kind of, within a course of a week, the bottom just fell out on pricing. It's just one of those things where we see, inflation in any market. I'd say bubbles form, and we've seen them form across history as we've gone. I won't get too deep into that, but if you look at, the housing bubble, 2008, you look at arguably the tech bubble, early 2000s, even the gold rush in many ways, like new opportunities, whether it's digital and tech or, traditional markets, they always create these bubbles because you've got actors, participating in these spaces. Not all of them being bad actors, not saying there's any ill will or negativity surrounding, what the founders did with Luna, but, these spaces do attract a lot of growth and a lot of opportunity, as well as inflated markets. And so I think it shows you, Luna and Terra, that situation, as well as Tether, they can just create liquidity issues, and there's nothing's necessarily safe if the bottom falls off with all the dominoes, in this order. And so my reaction to that is not necessarily that no one saw this coming. It's not a great situation. It's unfortunate for those that were invested and who lost, some life savings or just disposable income. But I think it kind of shaking out some of these situations can kind of be healthy for the crypto market as we move forward. Showing what really is viable from a product standpoint, but also getting some parameters around what we need to do as we move forward to kind of just make sure this doesn't happen again. There's protocols in place.
Yeah, I agree. I definitely think everything that unfolded with Terra Luna, it really just kind of highlights some of those protocols that are not as sustainable over the long term, and it's good to have those necessary washouts from the good and the bad actors. So I definitely think it was unfortunate for a lot of people that had Luna, that had a lot of their savings in Terra as a stable coin, and I think that it kind of just also opens up your eyes the difference between an algorithmic stable coin and then a dollar-backed stable coin, more of like a USDC. We've seen a lot more stability with USDC and more of that being not fluctuating as much. We haven't seen any issues with that losing its peg to the dollar, but I definitely think the algorithmic stable coin, that's yet to be determined if that's going to be a viable source of just value when it comes to how you can kind of store your money within a stable coin. But when this whole entire situation happened, what came after that was it really led to a big drawdown with the price of Bitcoin. I believe some of the lows that we've seen so far this year, the lowest Bitcoin got down to was somewhere around $17,500, and it created a domino effect with Three Arrows Capital, which was the next domino to fall. Now, Three Arrows Capital, they were a crypto hedge fund. They're actually founded in Singapore by Kyle Davies and Su Zhu. And the fund, they managed around about $10 billion in crypto assets. So they definitely managed a lot of money within the crypto game. But now it's virtually at almost zero now because they ended up having to file a Chapter 15 bankruptcy proceeding because a lot of the exposure that they had in Luna. Now, for those of you that may not know what a Chapter 15 bankruptcy is, It's really utilized to promote cooperation with U.S. courts and foreign courts to handle insolvency cases. So with 3R's Capital being in Singapore, they're going to follow some of the U.S. guidelines. So they had to file a Chapter 15 bankruptcy. And this was the result of 3AC. They actually default on a $670 million loan from Voyager Digital. So it definitely was a lot of money. And they also missed margin calls with other crypto lenders like BlockFi. So just like with Terra, 3AC was deeply involved with participating in risky protocols and received unsecured loans from Voyager. And they also extended loans to those same loans to their clients as well. So this definitely seemed like a situation where 3R's Capital was over leveraged, and just like Warren Buffett would say, when the tide goes out, you can see who's swimming naked. So I definitely think that was the case in this scenario. But what were some of your initial reactions and just your thoughts on the whole 3R's Capital situation?
Yeah, no, absolutely. Good reference there. I like the swimming naked. Yeah, I mean, one of those things where I didn't feel like I understood the landscape of this correctly when it first happened. It all happened at once. So, that domino effect of obviously Terra Luna, the backing of that being held by many other crypto, lending firms, crypto trading firms, that made everything just collapse, which called in margins. Companies were over leveraged. To be honest, I was reading fragments of stories of kind of what was going on, but it didn't all connect until more recently, where all this was triggered by the same, event. And so, 3R's Capital going under, and that led to Voyager and Celsius and other crypto firms. It just shows that, kind of back to that original statement, that we can't just, fractional reserving when it comes to bank lending and everything that we do is going to be part of growth and how you extend the market, right? So you have to have fractional reserving and lending to make a market grow and kind of create derivatives within that market. Same thing happened with crypto. You got companies that are lending too much, are hedging on the fact they have a certain amount of reserves, whether it's in their wallet or backed by Bitcoin, backed by Terra. And when these things, start to collapse, it just triggers this, chain reaction across the market. And so, crypto wasn't, avoiding that at all. It got to the point where, you got the 500x leverages. You've got companies lending to other companies that are backed by, obviously, stable coins. And so if one of those things, the linchpin in this was, Terra, that created that, it could have been anything else at this point. One thing going under causing that reaction to other markets. And so I think we just have to be cautious, just like we are with, equities, real estate, could be mortgages. When you're over lending money and then you're creating derivatives on a fractional reserve basis, this is always going to happen, I think. And so I'm not saying we can't get away from that, because you have to have fractional reserving in order to create products like mortgages and car loans, any kind of lending. But I just think we need to be careful, especially in a new market, because this will happen, and we'll see bankruptcies and we'll see failures.
Yeah, and I think another thing that comes to mind, I think you're absolutely right. With the fractional reserve, it has to be in place in order to create certain products and services to just create liquidity within the market. But I think where a lot of some of these companies can go wrong in the crypto space is they get themselves involved with over leveraging and being involved with risky protocols. And I think that since the crypto industry isn't really regulated as much right now as the traditional finance system, it's pretty much the wild, wild west, and not many companies have direction on what to specifically do. So we're going to probably continue to have these cases until we have more clear guidelines from a regulation standpoint. But I think in this 3R's Capital situation, another issue that also comes to mind is that, investors were also incentivized to stake UST Terra on a platform called Anchor for a return of 20%. So when you're promising people a 20% return, I even knew when I first seen the Anchor protocol, I was thinking about wanting to pursue it, but at the same time, I was like, this doesn't sound sustainable at all. And what will happen if this completely just falls on the ground? And, you know, staking is for those that may not be understanding what staking is. It's simply when you'll lock up your coins on a platform to get a certain amount of interest in return. So a lot of people were staking UST to get that return. And with 3AC, when everything kind of fell apart with Terra Luna, I mean, it was reported that 3AC had about $560 million in loan. They had $560 million in Luna. So they had a lot of money into the Luna protocol. And when all of this unfolded, it literally was just a chain reaction, like you said. And I think the risk asset correction that we seen with a lot of the prices in crypto, along with, you know, less liquidity, exposed projects that were promising these unsustainable APRs. So I definitely think that's what resulted in the collapse. And really from that point, you know, you had the Voyager, the BlockFis, the Celsius. They were all affected by the contagion with Terra and Three Arrows Capital. And Voyager Digital actually had to file a Chapter 11 bankruptcy because of the defaulted loan from 3AC. And all the Chapter 11 bankruptcy is just a form of bankruptcy protection that allows a firm to restructure their debts. So BlockFi, they ended up having to sell some of their crypto assets that were backed by 3AC loans. And it was reported that they had to liquidate about $1 billion in Bitcoin after 3AC defaulted on their loans. So it definitely was a big prevalent issue. And FTX actually had to get involved throughout this whole situation, and they had to loan BlockFi $250 million for a bailout to fulfill customer withdrawal requests. And then from there, you had Celsius. They had to do a Chapter 11 bankruptcy, and they ended up, you know, just freezing assets on their platform because they simply didn't have enough liquidity to fulfill customer withdrawal requests. So I wanted to get your thoughts, Alex, on, you know, how has the insolvency of centralized exchanges and customer assets being frozen on many of these platforms highlight the importance of self-custody?
That's a great point. And I think honestly these shakeouts do create a longer sustainable market. I think it's healthy for it, as much pain that it causes for, you know, people like their assets liquidated, frozen. I had friends that were on Voyager that, I mean, their accounts were frozen and they just got access back. So I guess we're good there with your assets. But I mean, if some of these companies go under, you're not necessarily getting those assets back. It's not guaranteed that, you know, your digital assets are safe in a exchange wallet. So, you know, I'm a user of Coinbase. I use Gemini. I've got a Binance account, a Kraken account. So I try to get stuff off those exchanges because, you know, these wallets that they hold, it's like a bank account. If a bank goes under and they freeze, they've got access to your money, and it's their money. So if everybody's trying to pull out money at once, like we saw in the 1929 crash, you know, sometimes those banks were frozen, and they basically said, "Sorry, I'm not giving. You know, you're the last one to withdraw the money, and the money's not there. It's went out elsewhere." It's so different with crypto. I think you've got to self-custody and understand your KYC methods because, you know, I hold stuff on exchanges. I'm guilty of it as well, but most of my major assets are pulled off into a hardware wallet and secured in a self-custody protocol. And so, you know, just like anything else, you got to make sure you know where your money is. You don't have to bury it in the backyard, you know, the gold, but, you know, at least have it maybe in your safe at home or in your wallet somewhere. And so I think to your point, people need to understand that wallet it may say your name on it and you've got access to it, but on their balance sheet, to them, like these crypto exchanges and trading platforms, that's a asset to them. It's a liability to us. And I read an article recently. I think I'm glad you brought this up because the article said just that. You know, I was looking at it as my wallet. I've got the password for it. It's my asset. I can just pull it off real quick. Like I'm sure Voyager, Celsius, even, you know, Three Arrows Capital, to them, everybody had assets with them. That was an asset, and to us it was a liability. And so when that company goes under, they've got ways to calculate that as their asset. If people keep on pulling out, like with the Terra Luna situation, everybody withdrew their Terra or sold it. That's why these companies went under, because they were saying that was their asset, and they were backing their company with these holdings, not expecting a chain reaction to just completely domino affect everybody's withdrawal. And so, and I don't know, it's kind of crazy to see, but just in your mind, you got to think about it. Hey, if it's not your keys and your coins, then you're not the custodial aspect is that you're not accessing your coins directly. And so they say not your keys, not your coins. It's very true.
Yeah, I think it brings it back to that exact point, not your keys, not your Bitcoin. And, the whole situation with the Celsius and the Voyager breakdown and freezing assets, I actually read a report on how the Chapter 11 bankruptcy, it kind of broke down some of the numbers with Celsius, and I kind of wanted to point some of these out because I think that this should highlight why you want to have self-custody. And pretty much the courts identified that their digital asset holdings fell from 14.56 billion to 1.75 billion between March and July, and the crypto lender has around 500,000 creditors, of which 4.7 billion are owed to customers. So as you can already see there, the amount of money that they owe to customers is far surpassing the amount of money that they actually have with their digital asset holdings. So they don't have enough liquidity to be able to solve these requests of people wanting to pull money from the platform. So that's why they had to freeze assets. And honestly, I don't think a lot of these people are going to get their money back, which unfortunate as that is, it really just brings back to the point of you got to hold your own keys. And I think the main important reason is because you ultimately want to control your security, your decentralization, your privacy. And if you can take ownership of your own private keys, it's going to give you the ultimate control, because like you said, Alex, when you put your funds on these centralized exchanges, it's their asset, and for you may think it's your asset, but it's really a liability to yourself because you're giving all of the authority to these companies. And, I think another reason also is because, with Three Arrows Capital, with Celsius and Voyager, they were essentially taking customers' deposits and they were lending them out on risky protocols to generate high yields, like what I provided with Anchor, with the 20% that they wanted in returns. And I think that people also have to realize that whenever a crypto exchange is going through a bankruptcy proceeding, especially with a centralized exchange, depositors are looked at as unsecured creditors. Now, what that means is that customers are going to be paid last and secured creditors are going to be paid first. And secured creditors are those that are like employees, banks, tax authorities, and bankruptcies can take years. So usually customers are paid, pennies on a dollar, if anything, after the secure creditors are paid. So I did want to get your thoughts, Alex, on, do you think that Voyager and Celsius will even be able to pay back their depositors after all of this madness is just settled within the court system?
That's a very good question. I can't say it's one that I can necessarily even answer from that aspect, but I think I'm hoping the health of those companies will regain. I know Voyager just unfroze the accounts of people that were holding assets, which is a good sign. It's kind of unlocked. We will see consolidation, obviously. Like FTX bought BlockFi. They actually purchased BlockFi as a company, and they're obviously FTX is a major one of the biggest players in the space when it comes to platforms and holdings and overall market penetration. So I think honestly we'll see these companies get consolidated and bought out, unless I don't want to say monopoly will be created, but to be what will be a consolidation. And so I can't say that it's the threat that these companies will go under and people will get their assets back, but just to know that it is unbacked. And so if you're not self-custodying your coins, then you do have the chance of, in these situations, not getting your coins back. But I think overall there's going to be some bailouts by other companies, whether it's a purchase or maybe FTX lends money to some of these smaller companies. I think we started seeing some of that, and hopefully the outcome isn't as violent as it was initially.
Yeah, no, I agree. I think Voyager customers are probably going to be in a little bit better shape than Celsius, because I just think Celsius, they owe so much to creditors in comparison to what they actually have on their balance sheet. It's going to be very hard. Now, I think like what you said with Voyager, how I did read that customers are now going to be able to withdraw up to $100,000 through the Voyager app. And this is mainly because with the most recent court hearing that they had, Voyager was pretty much granted access by the judge for users will now have access to $270 million in cash with funds that were held with the Metropolitan Commercial Bank through Voyager. So customers that had their dollars in their account that were stored in this particular bank within Voyager, they will have access to being able to get some funds. So I think that's a good sign.
FDIC backed? FDIC?
So I believe the Metropolitan Commercial Bank, I believe it is FDIC. I know they said that at the court hearing, the judge pretty much said that if any customers had their funds in Voyager that was backed by the Metropolitan Commercial Bank, that they will have access to withdrawing up to $100,000. So it wasn't much clarification on if the bank is FDIC or not, but I would think with them being a commercial bank, they most likely are. But I definitely think it's a good sign. And Voyager, they only owe, I read that their creditor claims are about 1.8 billion, but they have about 1.3 billion in crypto assets, and they still are waiting for how the Three Arrows Capital situation is going to unfold, because they lent out over 600 million. So I think when that settles, they should be in good shape. I don't know exactly what's going to happen and how much people are going to be able to receive, but I definitely think this just brings us back to self-custody. You don't want to worry about these different issues, and it's very important to hold your own private keys. So yeah, I definitely agree. But I definitely think that this brings us back to Bitcoin and why the Bitcoin network is just far more superior than many of these other altcoins. And I think when you talk about a store value and just a cap of 21 million Satoshis, many of these altcoins, they have an unlimited amount of supply of just coins that can be minted. And I think from a supply and demand perspective, Bitcoin, as it becomes more adopted with international countries, as it becomes more of a medium of exchange and a unit of account, I think that it's going to create more demand. And with the supply being capped, that's only going to help the price go up over time. So, with a lot of these challenges that we have seen within the crypto space throughout the year, how has these different events really increased your Bitcoin conviction?
Absolutely. That's the best part of the podcast right here is when we get to Bitcoin, right? Because, I'm invested in other stuff as well. I just think, to your point, there's so many, essentially the whole point of this is decentralization, right? Obviously there's projects on top of different platforms, different use cases, NFTs, stable coins, they all have different purposes and uses. But if you boil it down, Bitcoin was the start of all this, and the fact that there is a cap supply at 21 million, it's a deflationary asset. There isn't, every other coin out there has, an infinite amount of production and growth, which really just inflates obviously the market of these things, the market caps, but also the fact that the price is going to go down. Just like any other asset, if you've got, a limited amount, or if it's, a smaller market cap, the price and value of that good will go up. And so, Bitcoin has all those functions of a good store value and the way it's used and also the way it's held. And so, if you look at these companies that went under, they had Bitcoin on the balance sheet and they were backing some of their, stability with Bitcoin. And that's not to say crypto itself isn't volatile. We've seen volatility for, 12 years now. and a lot of volatility in this past 6-7 months. And so every asset is kind of correlated, and the market shrinks and expands. Bitcoin's not hidden from that as well. I mean, it's still correlated to the crypto market. If Bitcoin prices go up and down, so does the rest of the market, and vice versa. And so eventually, hopefully, that de-hedging happens from assets themselves when it comes to inflation, deflation, but also within the crypto market. I'm looking forward to seeing Bitcoin eventually, kind of decouple and de-hedge from the rest. But in general, my conviction has been, I would say, strengthened. Obviously, I've been to 3, those conferences. We were just there back in April. The energy's there, the excitement. You hear people talk about Bitcoin as a whole, but also the use cases for it, the spending abilities, the connections with vendors, and with layer 2 Lightning, which is phenomenal innovation. But even through all this market turmoil and instability, I think even that in and of itself makes me more convicted in Bitcoin, because you don't see these collapses with Bitcoin. It's not centralized like these other coins are, whether it's Ethereum or Terra. They're just massive companies holding these assets, and one mover and one shaker can literally disrupt the market, or one event like what we saw with Terra. And so, Bitcoin price does oscillate up and down, and it's an asset. It's gonna, just like real estate or oil or anything else, it's gonna have economic uncertainty. And so, if the economy shrinks or grows, it's gonna, play into the price of Bitcoin as well. But in general, I think there's nothing that will replicate the current Bitcoin network, and there isn't. I mean, everybody else is chasing the Bitcoin, network and how it functions and how it came about, and you really can't, because it's just one of those events that you can't replicate. I mean, the coding of it, it's built to the protocol in the system. I mean, it's a censor-free application. It's not centralized in any means. When it comes to proof of work and how that functions, and so to compare it to anything else is nearly impossible. And then you add the fact that it is capped at a finite amount, being 21 million. I mean, that just shows that the value's there, and it's going to grow as a durable good.
Yeah, and I think this really separates the difference between Bitcoin and crypto. We had a lot at the conference in April, how they said people kept saying Bitcoin, not crypto. And I think that this highlights that a difference of, like you said, I think with Bitcoin, the fundamentals have not changed with the consensus, with the proof of work system. Of course, the price is going to fluctuate when we have different things like this, these different chain reactions happening across Terra and Three Arrows Capital and Celsius and Voyager, is because they had to sell a lot of, Bitcoin. Some of these centralized exchanges, they had to sell Bitcoin in order to try to resolve some of these liquidity issues that they had. So I'm not surprised why the price dropped down as far as it did. But I think when you talk about a store of value, when you talk about an asset that is sellable across time and space, and how it can't be manipulated, it can't be changed, and everything that we're seeing from the Lightning Network and just the scalability of just the different privacy protocols that I've been reading about, Bitcoin is definitely going to give you the better benefit compared to these other altcoins, because when you talk about proof of stake, you're talking about a centralized system that you have the validators, the people that have more equity as validators, they ultimately can change the consensus. We're going to get into the Ethereum merge at the end here, but they can actually change the consensus of the network. And I think with Bitcoin, the difficulty adjustment, the halving system every 4 years, I mean, it really doesn't get no better than that. And I think it's a pristine system that a lot of people are going to realize that this is the standard, and all of these other coins are just trying to fight for that standard. But I don't really think that there will be no other altcoins that are going to be more superior than the Bitcoin network. So I definitely agree with you from that standpoint. And, I really want to talk about just Bitcoin mining and some of the issues that we have seen with the increased prices with energy throughout this year. And a lot of these events that we had throughout the year, it actually triggered the price of Bitcoin to be down more than 70% from its all-time highs. And usually when this happens, it becomes more challenging for miners because they are incentivized to earn more rewards when the price goes up, as they're contributing more to the network. But when the Bitcoin price goes down, the cost of mining Bitcoin can cost more than the actual rewards a miner will receive per block. And I was reading on bitinfocharts.com how Bitcoin mining profitability has decreased to 0.07 cents per day per 1 terahash per second in July of this year. And when I looked at it this morning for September, it's still around 7 cents per day as well. So it hasn't really changed much. And I think with the increased costs that we have seen globally with energy, electricity costs are typically going to be the largest cost inputs for a Bitcoin miner from what I've read online. And I think many of these increases are passed through electricity rates that miners are going to have to pay to operate their ASICs. And ASICs is just simply the mining hardware that miners will use to be able to mine Bitcoin. And I think that this has really caused some miners to shut off power because of the cost being much higher than the actual rewards. So, Alex, can you kind of explain, how the cost of energy going up this year, how has it impacted your Bitcoin mining business that you have with your partners? And if it hasn't affected your business, kind of just go through some of the differences between someone that is outsourcing a lot of your mining work that you do compared to a person that's actually doing all of the mining for themselves, like within their home.
Yeah, absolutely. So differences there are, obviously Bitcoin mining itself has grown so much. We saw a huge uptick of miners and investors in the space 2020 and then 21, kind of with that bull run of 20 up to 40 to then 60,000 per coin. And so mining, I would say it's become more popular, but with the exodus from China, a lot of mining was moved to the US, Canada, even other European countries. And so it created a lot of opportunity for, foreign investors, and also domestically here, we saw the growth of Bitcoin mining increase a lot. And then we kind of recaptured the market and became, honestly, one of the leaders in the Bitcoin mining space. But yeah, profitability, when that price went up to 60, everybody's making, way more money. But obviously, it retraced down to a third of the price, that 17 to 20,000 range. And so, miners who were producing Bitcoin at the higher price, obviously, the fractional amounts they were mining were worth a lot more in value. But on the same note, like energy costs went up. We had price of electricity, increase. These all depend on where the positions. Like obviously, some miners are, for example, oil companies. I know, obviously Exxon, like they have a bunch of gas and oil excess. They use flare. They burn off their excess oil and gas to create the product, and that is just wasted, output and energy. So for them, that is going that use case to use that oil flare off and burn it to create energy, which pumps back into the electrical grid for them to produce Bitcoin, and have their miners run. That's excess waste anyways. And so a company like that, they're taking that wasted output in excess and using that to create a monetary value. So they're mining Bitcoin off that. Other companies that are just pure, Bitcoin miners, they've got, obviously their input is electricity and their output is Bitcoin. They're using electricity to run their machines 24/7, upkeep the facility, and that output good for them is the hash rate in the Bitcoin. So, those ones that were solely running off the grid and just warehouses that have, obviously racks of Bitcoin miners using electricity to turn the terahash or the tera kilowatts into terahash. And so I would say it depends on how they were positioned, these companies. And so profitability was a little different across the industry based off, is it going to be, is it solar based, is it wind based, is it oil based, or is it just pure electricity? And so not too many companies that I know have gone under, but they were selling Bitcoin on the balance sheet instead of holding it because of the price difference. They're using a lot more electricity. They may have upgraded their machines to better machines over the course of that bull run. And so if you don't know, the ASICs that you mentioned, the application-specific integrated circuits, and so those ASIC mining rigs, they follow the price of Bitcoin. So we bought our machines kind of before. I mean, they were expensive as is, but we saw the price of our machines essentially go up 100% or 200% and double over the course of that bull run. And so, maybe a company that was newer, a mining company that was newer, jumped into space and bought those machines at the high, and they ended up paying, in this current market, higher price for kilowatts of electricity. So yeah, some of those companies might have started out and just got kind of squeezed because everything dropped. The price of the machines dropped. We just got an update of the current market of what these machines are going for, and they're basically kind of what we paid for before the bull run. And that that Bitcoin mining gold rush, if you will. So I think a lot of that plays into it. Profitability for us, we're not in it we're small, okay? So we're running some rigs out of a facility in Pennsylvania. We don't actually have the facility ourselves. We're not the ones who basically build the facility, put in generators, have clean rooms, have people running the facility. We're just purely being hosted by one of these mining companies. And the big ones in the space are Blockware Solutions, you've got Compass. They offer to clients the ability to just host a investor's machines, and that's what we do. So they host our machines. They run them in facilities across the country and the world. They've got locations in Wyoming, Kentucky, Pennsylvania, and our specific location is Pennsylvania. So, our input and our costs for us are just hosting fees, which are pretty minuscule, and then we've got the electricity fees, which are, I would say, pretty stable. I've seen an uptick in price a little bit, but for the whole, I mean, it's pretty much not a big expense or increase on our end. So we're still getting the same amount of Bitcoin. It hits our wallet every day, every morning. I get up and it basically hits my wallet in the morning. It's the same fractional amount of Bitcoin every morning. So we're not in it just basically use our Bitcoin and then take that as a profit and sell it for USD or to invest in something else. Our goal is to hold this in our wallet. And so, we got the long-term goggles on here. We're not trying to just be in and out. We're not here to just, accumulate Bitcoin, sell it, accumulate, sell it. We're holding it on our balance sheet. And so we're not worried about $20,000 Bitcoin. That's not our goal here. It's a nice, price point, but we're looking at the 100,000 range and up. And so basically our dollar cost average is changing as the price drops, but that's not a bad thing for us. Our goal is the amount of Bitcoin, not the dollar holdings of Bitcoin. And so, our wallet's just every day just pumping out, fractional amounts of Bitcoin. It's our hash rate comes in and we just hold it in our wallet. And so, we're looking at the 5 to 10 to 15, year range, and not just to us, miners maybe taking Bitcoin and selling it for their overhead costs, for their long-term and short-term costs. That's maybe their goal, but as a hosted miner, our goal is to accumulate. So,
yeah,
question.
Yeah, no, it definitely did. And I think, when the price, I love what you said about how we're not really focused on the price, we're focused on the amount that we're actually accumulating in Bitcoin. And I think when the price goes down, that's a good thing because, you're able to accumulate more over a longer period of time. And even though, you may have seen maybe a slight difference in electricity costs or the fees, it's not going to affect you as much because, you're not having to worry about other overhead costs that you may have to just maintain your mining operation if you're doing it all in your home. So, I kind of wanted to get your perspective on, for someone listening and watching that wants to get started in Bitcoin mining, like what would you recommend for them the best way to get started? Or would you say that it's best to look at finding some facility that can host it, like a Compass Mining or what you all are doing to kind of not have to worry about these other costs that may come about when we see these fluctuations with the price of Bitcoin?
Yeah, I think starting out, it's a good viable option. Before there wasn't the ability to have people host for you. There was just people mining their basements, their houses, using just basic PCs, and kind of crazy how we've gotten to this point where it's a whole industry of just mining facilities. It's not the traditional, drilling in the ground and producing gold or another products, but it's the network upkeep. It's mining bitcoins through algorithms and creating blocks. As a network validator, as a miner, you're upholding the network, and you're rewarded in hash rate. And hash rate is that is fractional Bitcoin, creating these algorithms and basically getting rewarded for that. I think as starting out as a miner, like, we obviously want to eventually pivot to take on some investments. We want to open a facility somewhere, probably in the Midwest, because of cost of electricity and connections we have. But ultimately, the goal is to have a small facility and have our own machines that we're running 24/7. It may not be a big operation, but it'll be enough to make it worthwhile. But we also didn't want to do that immediately because it's very scientific. You're running basically a digital, like a data center, and so you have to have it pristine when it comes to the cooling, the way it's cleaned. It has to be a clean facility because of dust and other issues, and there's a lot to know when it comes to like the scientific side of it. But I think as a new Bitcoin miner, I've got friends who, I'm about almost a year into this. I've got friends who ask questions about it, and they're now interested in buying machines themselves and plugging into Blockware, to Compass, to Core Scientific, any of those big industry players in the space. And so the best way to get in is just read up all these companies, look at the costs to get involved, the price of the machines, and then just kind of do research on how this works. And it's more simple to just go through one of these companies, have them plug your machine that you purchased in directly. You've got your wallet, and it shows your output and your inputs. You pay your bill every month for electricity, and then you see that Bitcoin in your wallet every day. And so I think gaining that a little bit of exposure to the Bitcoin mining side is a good way to start. And eventually, if you want to kind of grow that operation, you can grow it through a company like Blockware or Compass, or eventually take your machines from them after the contract's up and just start your own facility. And so I know Blockware just launched a used marketplace for their machines and rigs. And so me and my counterparts are we hold a LLC, and then we have our machines kind of listed as equipment under that. But if we wanted to sell machines, our S19s, and upgrade to the newest ones, we would have the ability to sell those and get out, or sell those and buy new ones. And so the space as a whole is growing to the point where it's just much easier as ways to get involved vicariously or indirectly, instead of just being a miner running a facility. To us, it's passive. It's not our full-time job. We mine Bitcoin as passive investors because we believe in the cause, and it's our long-term conviction. So I think starting out with one of these options is a good way to go. And if you want to fully mine eventually in a facility, then it's a good way to get that exposure.
Yeah, that's really interesting. I wonder, did you all get ASICs machines for your hardware? What type of machines did you all get? You said the S19s is what y'all got?
Yeah, we got the Bitmain ASICs, one of the most popular ones.
I see that one on here. I'm looking online too. I do see the Bitmain.
Yeah, see those prices too. They've dropped quite a bit.
Yeah, it looks like it says about 9,000, but then I see another one that says 4,800. But the one is 4,800. It says it's a new Antminer S19. But the one is 9,000. It says it's a Bitmain Antminer, but it has I think it might be because of it has the MH. I don't know if that's the power or the amount that is producing within the machine, but I think maybe it's costing more because of the actual power of the machine. But it looks like the prices are fluctuating from about 4,800 to 9,000. I don't know if that sounds about accurate of what you're seeing on your side in the space.
Yeah, and mostly because the miners themselves, the technology is upgrading. So, like our S19, we bought the Bitmain S19 Pros, And at that time, a year ago, that was the latest state-of-the-art model. The terahash was, you see the TH on there?
Yeah, I see that here, yep.
That was 110, that's what we got. And I think the new XPs, like if you look and see probably the $9,000 one is the XPs.
Yep.
And so those are the latest and the greatest of Bitcoin mining performance. And so those will cost more because I think the terahash is up to 140 now, which is the max.
Yep.
So these machines are just constantly being, upgraded, just like our PCs and our phones. I mean,
yep.
As technology gets better and better, they become more efficient. They can produce more terahash per an output based off kilowattage coming in. And so, our 110s were the latest of that current market. And now the new XPs, which I actually saw at the conference, they had some XPs there, and those are 140. So it just keeps on getting better and better, more efficient, and a higher terahash. And so,
yeah,
to that point, that's why that price is doubles, because it's higher output.
Higher output,
yeah. Market.
Yeah, that's what I was.
Those same machines were they were basically 14,000 a couple months ago.
I know they were high. I looked one time. Yeah, I looked at it one time, and it was like almost 14 to 18,000 when we had it at record highs when Bitcoin was at 69,000. So, but I think the best mindset, like you said, is to get started with, finding the machine right now. With the price being much lower, you can find something a little bit more affordable, and you could just find an actual mining company that you can host with, and you can still just kind of plug and play, and you can be able to start the mine. So I think that it's great to see the evolution and how you all are growing and being able to navigate within this space. And, I wanted to also kind of get your take on the whole just kind of ESG narrative. I know you sent me a great article earlier today about just the sustainability with the energy usage for Bitcoin mining is growing nearly 60% in a year. So, can you kind of talk about your thoughts on just the sustainability around Bitcoin, and how a lot of what we see in the media, sometimes they try to give a bad narrative around the energy that Bitcoin consumes with mining, just the mining process, and just, kind of your take on, what you're seeing in the industry, and kind of how that's just really FUD at the end of the day of just trying to take away the growth and the impact of Bitcoin.
It's a very hot topic. I mean, ESG essentially is impacting every single industry. It's almost like a buzzword, because I can't remember before 3 or 4 years ago, even the last two, I mean, ESG wasn't even talked about. It was it was there. We knew there was, the green initiatives and sustainability. That's always a positive thing. No one's by any means saying that's a bad thing, but now companies are so focused on that ESG component as being basically a value proposition to investors as well, whether it's a investment company, it could be a bank, it could be a manufacturer. Countries and governments are all focused on ESG and how we're using energy, and how we're also, sending it back to the environment. Is it clean? Is it creating more pollution? And so I think ESG has created a lot of FUD in the space, only because, we heard the last two conferences that guys like Kevin O'Leary and others talk about ESG and how they almost weaponized it against Bitcoin. The facts don't always match the narrative, right? And so I'm not saying every industry creates energy use. Most industries create pollution or, some other environmental impact. But the numbers don't add up. If you look at Bitcoin as a whole, I mean, this article itself, shows the energy uses of Bitcoin in basically terawatt hours across the world. It's not even, it's basically non-existent. It's like 0.16% of the world's energy use is going towards Bitcoin mining. They act like it's going to consume the entire grid at one point. That was the narrative, I think, 5 years ago.
Oh, I just wanted to see if you could see this chart. Is this the chart you're talking about?
That's the chart.
Yep.
And a podcast I was listening to a while back, Alex Berenson, I was positive that's who it was, created this report that kind of became the end-all be-all for Bitcoin. It was a report about Bitcoin mining, how eventually it's going to take over the entire energy grid, and it's going to crash the grid and all this stuff. And this was years ago. and then a lot of publications and news sources ran with it. And so, but the data that he showed wasn't accurate. It showed that Bitcoin energy use is becoming more efficient. It's becoming more sustainable and more green. This article says 60%. I mean, that's up from 35% a year ago. So we're headed towards probably one of the cleanest uses of energy. That's also creating economic product and economic output. This chart you have pulled up here. I mean, look at this. Like,
it's crazy.
Bitcoin mining, residential buildings, all this stuff. It's like,
they're comparing the energy compared to a lot of these different categories. Is terawatts? Is that what they're saying? The TW, they're just saying the amount of electricity output is much higher in these other areas compared to global Bitcoin mining. Is that what they're trying to state here with this chart?
Yeah.
Okay.
Compared to all this stuff, and it's like really not necessarily always accurate when it comes to the use cases. It is a very sustainable market, and it's becoming green. And like I said before, some of these companies are just wasting this output, like oil, gas, and flare off. I mean, that's just going to go into the environment and have no use case for it. By capping it with basically creating that energy output, re-engineering it back into Bitcoin mining. I mean, you look at that net positive, it's creating more economic output and value for the companies, but also reducing the wasted energy use.
And I believe this is the other one you was comparing about with the countries.
That's the one I was referring to. Yes.
Yep.
How it's become from 35%, was it last year, 36.8% in Q1 of 21, up to 64.6%. Like, that's almost double, and we're trending even farther in that direction. Where there's tons of manufacturers and companies that can't say this, that they have this clean of an output. Just compared to the rest of the world, it shows how we are trending in the positive direction. And so I think there's a lot of misinformation out there. I know the government essentially came out this week and said they're putting a bill back on the table that could potentially regulate proof of work or potentially ban it. We've heard this, I don't know, through the course of 12 to 13 years. We've heard this so many times. The reason why it's a bigger ticket item is because the popularity of Bitcoin, it's grown so much. I mean, the adoption we've seen across countries, across companies like BlackRock and Fidelity getting involved, all the way down to like companies surrounding the space. I mean, they're popping up left and right with jobs and opportunities. Now it's too big to ignore, and so we're back on the ESG and sustainability, possible proof of work ban. It's kind of one of those cycles where, it starts out where first they ignore us, then they fight us, and we're on to that. One of my buddies made that comment this week. He's like, we're in the fight for this stage. Before they're ignoring it. Oh, it's not going to happen. It's going to die. Bitcoin's dead. I mean, how many times do we hear that narrative? There's like 700 records of this being said across the past decade, and so we're to the point now where we're on the ignore stage. You can't ignore it. It's here to stay. It's a product. You've got BlackRock, Fidelity. I mean, they're offering exposure. It's holding it in a 401k, could be trading it. I mean, you've got the biggest players in the financial space involved, so you can't ignore it. We're on to the government's trying to fight it stage. That's where we are now.
Yeah, I agree. I think, it's just inevitable, just the growth that we're seeing with Bitcoin. It can't be stopped. And I think a lot of these narratives is just to try to find a way to take away just the shine of the value and the impact that Bitcoin is having, not only here in America, but you got to think about the international countries that really deal with authoritative regimes. When you talk about Zimbabwe, you look at other countries that deal with record levels of inflation at just higher levels. They need something like Bitcoin that can give them a hedge against just their governments, and I think that it's really bigger than us. I think here in the Western world, we have a lot of flexibility and we have a lot of opportunity when it comes to utilizing Bitcoin, but in other countries, they really need it, and they are dealing with authoritative situations where it could really help them, and it could be able to change the landscape of their economy and just the economics of money. And I think when they come out and they say these different things about it just burns so much energy, they don't really think about the impact that it has as a store of value and how it can help these people in these international countries. So I think you're absolutely right. And it kind of also brings me to Michael Saylor. He talks about energy, and I love the way he describes it because he really just gives a history lesson where he talks about like when we created boats and when we started to evolve as a civilization, when we started creating cars, when we started finding the way to produce food, these processes cost more energy, but we got a better output. People are more healthier. People are now able to travel more faster to their destinations. And I think, with Bitcoin, you can't really just think about the amount of energy that is consuming. And it's not really like it's a lot of energy when you compare it, as we pulled up the charts, when you're looking at a lot of these other categories, kind of like what you said, Alex, in the past, like, Christmas lights are going to burn more energy every year than just mining Bitcoin or just washing machines. So I think that people are just misinformed. And I don't know if you heard of this book, but it's actually one that I want to check out. But it's kind of talking about what we're highlighting. But it's by Alex Epstein. It's called Fossil Future: Why Global Human Flourishing Requires More Oil, Coal, and Natural Gas, Not Less. Have you heard of that book? Or
I have not. I know Alex Epstein, and he's got great content, so
yeah,
it's a fantastic book.
Yeah, I've heard he was on Pomp Podcast. He was on Peter McCormick's, Stephan Livera, and he's talked about it, and he just really said, like, they're really just misinformed and how, we need more energy. It's not a bad thing. So I think that's kind of what we're, talking about, in this particular topic. But,
there's so many, to your point, I mean, you got to look at the economic output. And so, Bitcoin uses more energy, but it's also a superior network. Almost, rivaling the banking system. And I mean, in a way, it's becoming a superior network. So everything that gets better and more advanced is going to have to use more energy. Like, we can ride around in carriages with horses still and reduce, energy output and emissions. But at the same time, like, we're traveling in planes and rockets, like, we're not there anymore. And so it saves time, it saves resources. Everything that advances through society has to have a greater use of energy to become a more superior system. And so Bitcoin's no different if you look at it that way.
Yeah, I agree. No, I definitely I definitely think that is really important to look at it from an economic output standpoint. But definitely wanted to kind of finish things off here with kind of just talking about the Ethereum merge. As some of you may not know, but we actually have Ethereum is going to be moving from proof of work to proof of stake on September 14th, which is next Wednesday. And they're literally about to change their entire consensus. And I kind of want to get your thoughts, Alex, on what you expect, and how do you think that this could have an impact in just the crypto market as a whole.
Yeah, I'm actually really curious about this. Because we've talked about proof of stake, a handful of times on this podcast, and we knew it was coming. And now that we're 3 to 4 days out now from the actual second iteration of that merge with the Paris, development. So I don't know what to expect. I mean, I think they don't even know what to expect at times, but it's probably the biggest change for, Ethereum as a company to go from the previous proof of work. And I had friends that mined Ethereum. I know even guys like Jason Williams, one of the OG Bitcoiners, with his company, he was mining Ethereum and just selling it to buy more Bitcoin. So he was mining. There was a nice profit return on mining it now, and so going to a proof of stake, validation and consensus network, it's really going to change things. I mean, the worry there is, obviously centralization. Like, it's going to be based off the biggest wallet and bag holders of Ethereum is going to have the decision of being the network validators. There's probably enough spread across holders, whether it's companies or retailers or individuals like us, I think there is enough to kind of make this a consensus network and not centralized with a couple big decision makers. But as things get traded around and moved, I mean, who knows? What if people start buying up all the Ethereum and buying us out at certain price points as retailers, and then next thing you know it, a couple big people in the space are the ones who hold the most, whether it's the CEO of the company or it's Fidelity, BlackRock, whoever. I'm saying
they can control.
I don't know if you can't control that, and so
yep.
I understand they say it's going to be 99% more efficient from an energy standpoint, but like we said before, it takes energy and that kind of momentum to get a better output and a better security. And so shifting from POW to POS is really just, it'll tell what happens with Ethereum next, but I think it's going to really change the system, and I don't know if that's for the better or for worse. I don't think we really know yet, to be honest.
I know.
I have my opinions of it. I'm not going to bash that move because I do hold Ethereum as well. But
I know, me too. Me too.
I just think if you do enough research in the space about proof of work and proof of stake, I mean, having machines spread out across the world, creating that incentivized network of physical and tangible validators, which are those mining rigs, and investors like myself, wanting to be in the space. It's digital real estate. I own real estate in the space of the Bitcoin network. Not me as a holder of Bitcoin, but me as a, someone who's upkeeping the network as a miner. And so getting to that proof of stake consensus, that just changes the whole landscape of it.
It does.
Because the focus right now is energy. So we will see what happens. Yep. TBD.
Yeah, I agree with you. I'm not really sure what to expect. And, I don't know if this is going to, help Ethereum or if it's going to, hurt them over the long term. But I definitely think people have to just understand the main distinct differences between proof of work and proof of stake. And, proof of work, which is what Bitcoin consists is more of just a decentralized network that's verifying transactions. Whereas with proof of stake, kind of like what Alex is saying, it relies on validators that contribute to the network. And when you have more validators that own a bigger percentage of the network, they can ultimately make certain decisions to change the protocol. And I think this is a lot of the arguments that people have, came to the surface to talk on, is that this can really, facilitate a high concentration of wealth among a small number of validators, and it can also just create a barrier for just entry with getting in the network. With Bitcoin, everyone is on the same playing field. It's a decentralized network, and it seems like it's more of a community. It's not you don't have someone sitting at top making certain decisions to change the consensus. So, I don't know what to expect. I know they came out and said the reason why they're doing this is because they want to reduce the energy consumption. And I think it goes back to the whole ESG thing. They're trying to follow that narrative. And when you think about it, a lot of the traditional finance system, they are wanting to move into that ESG space. And maybe Ethereum is wanting to try to find a way of getting more involvement from these these bigger institutions that can come in, because it is lowering energy consumption. But I think people have to understand the difference between Bitcoin and Ethereum, and understand that, like what you said, Alex, more energy with Bitcoin, you're going to get a better economic output. It's the most decentralized and secure, and you can't beat that. And I think once these institutions educate themselves, they'll really realize the better asset class, the better crypto asset to be in. So we'll see what happens, but I'm looking forward to it. But I think it's definitely going to shake the market up a little bit next week. So we'll see what happens.
And I'm sure more companies will push, for proof of stake. I mean, these are kind of I'll say Ethereum's probably the major, leader in the space. And so I guess whatever happens going forward will kind of impact the rest of the market. It may shed some more light on it, but also could, people that don't understand it or are educated might say, okay, well, we got to put more pressure on Bitcoin miners. It's gonna be interesting to see. But I'm sure the leadership at Ethereum, they did it for you, to your point, the energy consumption, also sustainability,
scalability. Yep.
To also kind of appease their investors, make it more of a green company, but you're just gonna lose some of that decentralization as a company, and so that's the negative impact of that.
Yeah, I definitely think the trade-offs, like you said, they're trying to reduce their energy consumption, and even though that may help from a scalability standpoint, the trade-off is decentralization. And with Bitcoin, there are great scalable solutions that is coming to the surface now when we think about the Lightning Network, as we talked about before. And there's just a lot of things on the privacy end. I've been reading about Fediment and just these other companies that are trying to enhance just the privacy perspective of how you take custody of your Bitcoin. A lot of this is going to help with scalability, and I think Ethereum, they're making the best decision that they feel is going to be best for either their validators or the retail investors involved with their network. But it's yet to be determined how this is going to impact the whole space, but definitely looking forward to it. And I think there's a lot of exciting things that's going to happen just within the Bitcoin space within the future. But yeah, Alex, this was a great conversation. I loved every second of it, and I think this was a good update on just kind of getting people educated on what's happening in the space, and just our take on some things happening from a Bitcoin mining perspective. But is there any other things that you want to share with the audience, or any other ways people can connect with you and kind of follow your journey online?
Yeah, I'm on Instagram, Facebook, and Twitter. Various names on there. We may post these after that, but feel free to connect with me. And I'm always trying to post and repost, good content. Not just Bitcoin, other advice, real estate or investing advice, but mostly these days my focus has been kind of centralized on Bitcoin as a avid investor and someone that just wants to see the space, flourish and grow. Which it has so much. So, like I said, appreciate being on here. I love these conversations, Kevin. It's always fun. It's always a good time. And hope the audience gets some good takeaways from this.
Yeah, no, I know this one will be tremendously valuable, and I thank you once again, Alex, and thank you all for listening and watching, and take care.